I got paid. Bum. I got paid. Bum. I got my check. I got my direct deposit. Bum. Woo! Welcome back to Strongman Personal Finance. Once again, I have been paid delicious, superstitious, surreptitious money to analyze the financial statements of a company known as Snowflake. Oh my God, I'm a liberal. I'm a snowflake. Everything offends me. Oh my God. So in this video, we're going to analyze the financial statements of Snowflake. Am I going to tell you whether the stock's going to 10x my hidden hex? No. But if you're wondering about Snowflake, if you're wondering about the financials and you want to actually look at financial statements instead of just buying a stock because it went up a lot, like 99% of you clowns do, then maybe you should consider paying me $40. Click that link, send me money, and I'll make you a dedicated video. So let's dive into Snowflake. And yes, I was compensated for this video. I was paid $40 to make this video. Snowflake is I would say, a decently popular stock on YouTube. I've seen it here and there. And didn't Warren Buffett, wasn't he invested in this at some point? Maybe. But anyway, I like to go to Wikipedia to get like a broad overview. It's a cloud computing-based data cloud company based in Bozeman, Montana. Where's that? Montana, obviously. It was founded in July. It was publicly launched after 2 years. The firm offers a cloud-based data storage and analytics service. And everything's about data in the future, bro. Generally termed data as a service. It allows corporate users to store and analyze data using cloud-based hardware and software. Services' main features are separation of storage and compute, on-the-fly scalable compute, data sharing, data cloning, and third-party tools support in order to handle the growing demands of growing enterprises. So basically, it's a cloud computing data company. Okay, data's the future, bro. Do I know exactly what they do? No, but it seems like if you have a bunch of data and you want to put it all together and make it easily accessible and able to analyze data, you can use Snowflake. And this is actually pretty helpful to larger companies because there's companies that they're just massive entities and there's so much data they have, but maybe accounting has some data and marketing has other data. To bring them together, you need to have a place where all your data goes and you can analyze it. That's basically kind of what they do, okay? At least that's my simple understanding. So let's go ahead and look at the stock price because all that matters is whether the stock went up or down. So it hasn't been publicly traded that long, it looks like. This is a 5-year chart and it only goes back to, it looks like the 2021. So we can see the stock had a couple pumps, okay? This stock was roaring during the cloud market. It got as high as almost $400 at some point. And now it's down to $167.40. So it went down, so it's a bad stock, right? Let's look at the market cap. $54 billion, pretty respectable. Revenue, $2 billion. Woo, look at that price to sales, baby. Wow. So price to sales is where you take the market cap or the price of the company, of the entire company, divided by the revenue or how much they've earned in revenue in the past 12 months. Usually it ain't like 25. That's pretty crazy. Okay. Usually price to sales, depending on the industry, is a lot lower than that. What is Microsoft's price to sales? It's real quick. Let me defer Microsoft. It should be the first one that pops up. That's weird. So Microsoft's price to sales is like 10, okay? It's a little probably like 11 and a half. So Microsoft, from a price to sales standpoint, is cheap. And Microsoft is highly, highly, highly profitable. Highly, highly, highly profitable, okay? Whereas Snowflake is unprofitable. That's right. They're losing money. Let's go look at the overarching financial metrics. So I like to look at revenue. It's like a staircase to heaven, okay? It's a staircase to the future, bro. Basically consistent, perfect, delicious revenue growth. If you look at their growth rates, they're slowing down. The growth rate is slowing down. Makes sense, right? But they're still growing revenue very, very, very quickly. Like 50% year-over-year revenue growth. I wish my YouTube channel would have that. So they're a very high growth company. That's why people like this. Oh, growth, my oath. Gross profits going up. Operating income over the last couple of quarters has gotten worse, though. Okay. The gross operating income has gotten worse. What about net income? They're suffering more and more losses every single quarter. So they're not while they are approaching profitability, as you'll see, they're still unprofitable. Okay, they're still losing money. But as a percentage, I think they're doing better. So gross profit margin has, this is the top of the income statement. This is the revenue minus the cost of goods sold divided by the revenue. This is basically their profit from just the service they sell, excluding operating expenses, advertising, marketing, interest. Look, those aren't operating expenses, but interest and taxes, all that is excluded from gross margin. Their gross margin has stayed pretty significant, pretty high, 65%. And it's gotten a little bit better over time. Their operating margin is pretty bad, okay? Negative 40% in the most recent quarter. So they're, from an operational accrual accounting standpoint, they're losing money, okay? And they're losing money big time. Negative 40% operating profit margin. That ain't too hot, but it's getting tighter. You see what I'm saying? Like it's negative 100, negative 100, and then it gets better and better. Now it's at negative 40. So the company is getting closer to profitability, but they're not yet there. The main reason this company's valuation is so high is just because of the revenue and the potential future profits this company can make. But yeah, they're losing money hand over fist. Okay, so keep that. This kind of reminds me of Palantir. If Palantir actually kept growing revenues impressively. This is an impressive company. If I was going to be a fanatic, if I had to choose between Palantir and this to be like a shill, I would probably shill this because the revenue growth is faster. Palantir's like, whatever, it's a different story. Profit margin, not too hot. Getting better, not too hot. Free cash flow margin, they have positive free cash flow. So they have negative operating profit, negative profit, but they have positive free cash flow. Why is that? I wonder if they have a lot of stock-based compensation. I don't know. We'll see about that. So overall, they're cash flow positive, and they're very cash flow positive. At least the last quarter they were. They're doing pretty well from a cash flow standpoint. So I don't think this company's going bankrupt, but they're going to definitely dilute shareholders. Let's see the shares outstanding. Yep. Going up, 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 up. Diluted shares outstanding going up, up, up. Not crazy, but they've been known to issue shares before, okay? And it goes up and up and up and up and up and up and up, okay? So they're definitely diluting the shareholders. We'll skip the balance sheet for now. Let's look at cash flows. Share-based compensation, 66. Okay, look at the quarter before that, 229. 209, 172. They have a lot of stock. This is basically Palantir. Okay. A lot of their employees are paid with stock as opposed to, they're paid with cash, obviously, but they also reward their employees with a lot of stock options. Okay. And that cost of the stock options, which is a real cost because it dilutes you, is spread out. It's recorded as an expense for the options over the options vesting period. So that's why you see these stock option expenses, which are huge. They have huge stock-based compensation. It's dropped in the last quarter, right? It's dropped pretty significantly. But for all the quarters before that, they have a lot of stock-based compensation, which is the main reason they have losses, is because of stock-based compensation, okay? But they are able to generate positive operating cash flow because instead of paying their employees in cash, they're saying, oh, you'll get stock in the future. Don't worry, you'll get stock in the future. That's partially how they're paying their employees, okay? Let's see. Acquisitions. They do like to acquire other companies. Let's see. Share issuance. Nothing insane. But we'll see more of this on the financial statements. I guess we can look at ratios. P, negative 63. Price to sales, 26. That's insane. Woo! Look at that, baby. Oh, mama. If you're like a value investor, you probably crap your pants looking at this, man. A 26 price to sales, negative PE, price to books of 10. That's not cheap by the metrics, okay? So let's go ahead and dive into the 10K. So here we have some more information about what they do. From January 1st, and sorry, this is small, sue me. From January 1st, 2023 to January 31st, so in the course of a month, they process an average of approximately 2.6 billion daily queries across all our customer accounts, up from an average of 1.5 billion daily queries during the corresponding month of the prior fiscal year. Wow, that's a lot of searching, okay? Let's see. There was a couple other metrics they had in here. As of January 1st, 2023, we had 7.8K, 7,800 total customers, an increase from 5,900 customers from January of the prior year. That's a pretty big increase in customers. As of January 1st, 31st, 2023, our customers included 573 of the Forbes Global 2000. So these aren't like podunk companies. These are big boys, okay, and big girls. Based on the 2022 Global 2000, they have a list of 2,000 stock companies. Oh my God. And those customers contributed approximately 41% of our revenue for the fiscal year ended January 31st, 2023. Wow. They're definitely doing good. As our customers experience the benefits of our platform, they typically expand their usage significantly, as evidenced by our revenue retention rate, which was 158%. So not only are people signing up in droves, they're staying and they're paying more. Okay. The revenue is not a problem for this company. It's profits. And the question you have to ask yourself is, when are they going to become profitable? They're getting closer to it. But just like Palantir, they have a lot of stock-based compensation expense. And remember what happened to Palantir? Palantir kept getting wrecked. Okay. Eventually, it became profitable, barely. And now everybody's excited about it. But you can still lose a lot of money buying in now. I'm just saying. Okay. So blah, 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 blah. Let's look at some risk factors. I like to look at the risk factors. I skimmed this very briefly, but I wanted to see what stood out. We've experienced rapid revenue growth, which may not be indicative of our future performance. Okay, that's a standard, par for the course. We have a history of operating losses and may not achieve or sustain future profitability. That's a big one. We expect our costs and expenses to increase in future periods. In particular, we intend to continue to invest significant resources to further develop our platform. In addition, our platform currently operates on public cloud infrastructure provided by Amazon, AWS, Microsoft Azure, and Google Cloud. And our costs and gross margins are significantly influenced by the prices we are able to negotiate with these public cloud providers. So basically, the big daddies, okay, Amazon, Microsoft, and Google, have a pretty significant amount of control over this company's margins, okay? If these companies really wanted to compete with Snowflake, they could absolutely destroy them, okay, if they wanted to. And the funny thing is, they are in a competitive industry, and look who they compete with. Our competitors includes large, well-established public cloud providers that compete in all our markets, including AWS, Azure, and Google Cloud Platform. So the companies that host their cloud infrastructure are the ones they're competing with. That should be something you should consider now, isn't it? Okay. And they tell you right here in the risk section of the 10K. So let's see. Blah. If we fail to innovate, blah, blah, blah. Blah, 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 blah. Disruptions. We expect fluctuations. Okay. So a lot of these are just like generic risk factors. So sometimes you want to skim through them, but you definitely want to read them, because then you get some pretty interesting insights, like their cloud infrastructure is hosted by their competitors. Okay. So let's go ahead and see what else we can ascertain here. All right. Next thing I like to look at. So you should read about the business. Technically you should read the whole thing. Okay. Read about the risk factors, legal, blah, blah, blah. Management's discussion and analysis. Okay. Sometimes they have like interesting stuff on here. Let's see. Stock repurchase program. Our board of directors authorized a stock repo program up to $2 billion of our outstanding common stock. So if they bought all their stock back right now, they could potentially buy back. I'm not saying they're going to do this. And obviously it wouldn't be these exact numbers, but theoretically they could buy back 11 or 12 million shares based on the current share price with $2 billion, which is roughly, how many shares outstanding do they have? Let's see. 319 million probably. So they could buy back 12, 4% of their shares. I mean, it's not the end. It's not going to change the world, but I guess it's something. So that's that. Okay, sorry, I got lost for a second. Business combinations. Okay, they're acquiring other companies. Streamlit. Let's see. Let's see. Product revenue and free cash flow. Blah, 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 blah. I'm trying to find if there's anything interesting on here. I mean, basically, like, revenue is not a problem with this company, at least in the past. Here we are. We're getting to some revenue here. So basically, under. Oh, hold on a minute. No. No. Okay, here we go. Here's some disaggregated revenue. So a lot of the times when you look on a company's financial reports, they're going to show like one number for revenue on the income statement. But a company could have multiple business lines. So you want to make sure you're paying attention to that. So what I do is I usually search for the word disaggregated. And that usually pops up the different types of revenue that a company has. Because what companies will do is in the management discussion and analysis, which we're at right now, they'll break out the revenue so you can see it separately. So if you're looking at this, okay, we can see for the fiscal year ended January 31st. So this is year-on-year revenue growth. They break down product revenue, which is 94% of revenue, and professional services and other. So clearly both types of revenue, both types of services they provide are increasing, but it's mostly product revenue, and that's the one that's growing the fastest. So that's something that you could keep in mind there. Okay, but you could find a lot of interesting stuff in here. Let's see. Product gross margin has increased 72%. The gross margin of professional services is negative. So their main revenue source has a much higher gross margin than their less, I guess, revenue generating service, professional services. And professional services has a negative gross margin. Okay, so they're losing money on professional services. Thankfully, it's a small part of the revenue, but it's actually having a pretty significant impact on their overall gross margin. Look at this. If they just had only product revenue, they would have a 72% gross margin. But because of this professional services, even though it's a small part of the revenues, it still hurts their gross margin. So that's a very interesting. See, you read the 10Q, read the 10K. This helps out. This makes sense. You can see what the main generator of revenue is, and you can see where they're losing money and making money. So they need to fix this. Why are they even doing this? Like that's a 7% swing in gross profit. Okay. But even then, if you compare it to the prior year, their gross product gross profit has gone up 2%, and they're approaching profitability from a gross margin perspective for professional services. Okay. So that's all interesting stuff. They're cutting sales and marketing. That's going down. That's good. Let's see. R&D is flat. They haven't really changed R&D. General and admin, they've cut that as a percentage of revenue. Overall, I mean, they're definitely getting closer to profitability. Okay. So that's other interesting stuff that I have seen. Well, look at that cash flow from operations. Look at that increase. Woo! They're just printing cash now, baby. And they even tell you why it happened. Okay, but we can see that in the financial statements. So let's go ahead and look at the balance sheet. I like to look at it on here. So we go down to item 8. Let's read the auditor's report. We've audited the financial statements. We have audited, blah, blah, blah. In our opinion, the consolidated financial statements referred to present fairly in all material respects the financial position of the companies and the results of its operations and its cash flows for each year ending January 31st. So basically they're saying the financial statements themselves, there's reasonable assurance that you can rely on them. Basically, you can trust the financials. Not wholly, but there's a good shot they're probably good. Also, in our opinion, the company maintained in all material respects effective internal control. When you look at an auditor's report of a publicly traded company, I remember this from the CPA exam, there's two opinions. There's the opinion on the financial statements, are the numbers accurate? And then they make an opinion on internal controls over financial reporting. Are there systems in place to make sure that the numbers that are popping into the financials are functioning properly? Those are the two opinions that they have. Okay. So overall, they've got a good audit report that you can generally rely on the numbers, and they were audited by one of the big daddies, PwC, which I don't work for, and I never will. So let's look at the balance sheet, okay? Balance my allants. Cash is down a little bit. Short-term investments are up, so they just probably park some cash in short-term investments. Accounts receivable has gone up, so basically and that's obviously attributable to partially at least growing revenues. Deferred commissions is up. That's another revenue. Prepaid expense, that's a deferred revenue at some point. Or revenue they've already earned, they just haven't collected yet. Prepaid expenses and other current assets. So overall, their current assets have gone up by about $500 million. And that's mostly because, well, they increased their receivables and they've generated positive cash flow. Long-term investments has gone down. That's interesting. Did they get impaired? Did they write them down or did they sell them? PP&E has gone up. They're buying property. They're leasing more. They had huge acquisition. Look at this. Goodwill is up 640 something million dollars. So they've had some pretty big acquisitions going on here. As a matter of fact, Goodwill is probably like 8% of their total assets. It's an intangible asset. Intangible assets have gone up. Deferred commissions over long term. I guess these are. I wonder what these are. I wonder if this is something they have to pay. Usually assets become expenses over time, but yeah, we'd have to look into that later. But they do have some deferred commissions, but it's not like an insane part of their assets. Let's see. Accounts payable up a little bit. Accrued expenses up. Okay, nothing crazy here. Deferred revenue. Okay, obviously that's gone up because their revenue's gone up. Deferred revenue becomes revenue as it's earned. So overall, they have total current assets of almost $5 billion and current liabilities of $2 billion. They're not going bankrupt, okay? They have positive cash flow, okay? And they have plenty of cash in short-term investments that they could sell. They're going to be fine. Let's see. Long-term assets, insignificant. Wow. Yeah, or long-term liabilities, excuse me. Overall, they're in a very great financial position. As a matter of fact, they could literally take their cash in short-term investments and pay off all of their debt if they wanted to. They're doing pretty good, okay? At least from a balance sheet perspective. That's what happens when you dilute the shareholders. Okay. Common stock, additional paid-in capital are up. Obviously, they're issuing shares. Accumulated other comprehensive loss. We'll have to look and see what that is. And accumulated deficit. So basically, all of their equity comes from share issuance. Basically, all the increase in their equity. Because their equity went up. But it ain't from profits. It's from issuing shares. So overall, yeah. So they're not going bankrupt. Okay, that's my conclusion. That's pretty obvious. I mean, the income statement's great. We saw a lot of the percentages. They're growing revenues. Their gross margin is being held back mostly by professional services, which has a negative gross margin, but they're increasing margins in their product revenue. They're growing their revenues massively, and they're increasing their margins on the product revenues, the main source of revenue, and they're cutting expenses. So they're closing in on profitability, but it's obviously not there yet. Okay. So you'll see the net losses get bigger, but those are just absolute numbers. As a percentage, they're going down, which is kind of what matters. All right. Let's see. 2023. So they had almost 20 million of losses that skipped the income statement and went to the statement of comprehensive income or comprehensive loss from change in unrealized gains for available for sale debt securities. So I guess, a lot of companies are experiencing this where they buy bonds, park some money in bonds, and then the bonds go down in value because interest rates go up, and they book those losses in the statement of comprehensive income. But this isn't basically if rates ever go down, this is going to go up. So I wouldn't be too concerned about this. It's not the end of the world, but it is a loss. Okay. They are holding debt securities that have gone down in value. It's just not a material amount. But if they had to sell those debt securities for some reason, then this loss is going to go ahead and hit the income statement. So that's something that could potentially happen. Okay. Oh my God. So they've been giving out, let's see. What do they do with shares over the last, let's see. Okay, redeemable convertible. So they haven't given out any, this thing's huge, okay? But I have to stay zoomed out or I can't see it. So they have not, over the last year, they have not given out any preferred stock. They have issued a total of, looks like, 10 million shares. Yeah, so most of their shares are being issued. So they're giving out Class A and Class B common stock through exercise of stock options and vesting of RSUs. So most of their stock issuance isn't to like finance acquisitions. It's mostly due to stock options. They did issue 1.9 million shares with to effectuate a business combination. But most of the shares are coming out because of stock options and because of restricted stock units. Additional paid in capital, that's also from, I mean, basically, you have to combine additional paid in capital and the amount of common stock. That's how much cash they've generated basically from all these different transactions. Mostly stock options, okay? Let's see. Actually, I stand corrected here. So we could see, so the total number of shares that went out, most of the shares are going out through stock options, but most of the cash that they generated was from, most of the increase in total additional paid in capital is from the business combination. So most of the equity increase is from the business combination and stock-based compensation. So overall, there's a lot. The equity increase is coming from common stock issuance and the business combination. Okay, that's weird. I like how they put this on a separate line. Stock-based compensation. So $890 million of equity came from stock-based compensation. So if you see their book value going up, it's like, oh, their book value is going up. It's because of stock issuance. All right. Let's see anything else. Basically, that's it. Okay. Issuing stock-based compensation, and a little bit of business combinations. All right, let's do statement of cash flows. All right. Oh my Lord. Look at that stock-based compensation. This is just like Palantir, man. This is all these tech companies have insane stock-based compensation. Okay. So stock-based compensation was larger than their profit. So if they didn't have any stock-based compensation and they didn't pay their employees any more cash, they would technically be profitable. Okay. Let's see. Unrealized gains on strategic investments. So they lost $46 million on investments. Okay. Let's see. Amortization of deferred commissions. Yeah. So the big daddy on here is stock-based compensation. Okay. But they're generating a lot of cash from deferred revenue, which is upfront payments. Let's see what they spent money on. PP&E, nothing crazy. Software, nothing crazy. They spent $362 million on an acquisition, and they gave out some stock for that too. Purchase of intangibles, down. Purchases of investments, down. Sales of investments, down as well. Basically, they're just parking a lot of their extra cash in investments, okay? That's basically what that means. I mean, you could look at it more, maybe they're buying some other company's stock too, but you'd have to look in the notes for that. And maturities and redemptions of investments. So overall, like, the main thing that they spent their investable cash on was business combination. They had this business combination here. And then financing, they generated $39 million from stock options and another $40 million from employee stock option purchase plan. So they're generating a decent amount of cash from stock options. So overall, like, crazy revenue growth for this company. Crazy revenue growth. I would be concerned about them hosting their servers with their main competitors. That's weird. But overall, I mean, their revenue is getting better. They're becoming closer to profitability. They are not too bad. All right, let's do some comments. Pay me $40, I'll make a video for you. Hello. Shut up. Hey, Kurz. What is this? You are the best. Thank you very much. Can you please look at what day stock? Yeah, for $40 I can. Classic robbing to pay Peter to pay Paul. This was a popular pandemic. Yeah, I remember people talking about this stock. I mean, it's got incredible revenue growth, and their profit margins, at least they're on the top of the income statement, are pretty good. And they have very strong cash flow. Stock-based compensation. I've been random people on me telling me I should invest in stuff. Of course! Revenue my avenue. So basically, once the stock price flatlines, a whole lot of stock from employees are hitting the market. Of course. So are you bullish on Palantir now? No. I can't be bullish. I'm the anti-Palantir guy. Admit he never said he's bullish, you clown. Let's see. Admit you need like 200% gain, blah, 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 blah. People are debating in the comments. What do you think of Under Armour? I don't know, but $40 will entice me to talk about it. I'm just grifting, man. I'm about 150 from break even, so I'm probably going to be holding Palantir for a while. I wish you the best. I wish you the best. Strongman owns shirts. Shockingly, yes, I do have a shirt. I will buy your Palantir stock for $150 a piece if you want. I'm assuming a lot of risk. Let's see. Forget Strongman wearing a shirt. He appears to not be dipping. The apocalypse. Oh, I quit dip like 3-4 months ago, man. Let's see. Strongman with a shirt and not dipping, and Jeremy selling Tattooed Chef. I'm heading to my bunker. I like how me wearing a shirt is equivalent to Jeremy selling his biggest, most horrible investment he's ever made. That's the same equivalency of like craziness. All right, guys, interesting company, but I don't know. Sometimes, with investing, even if companies look good in the past, it doesn't mean they're going to look good in the future. I don't know. Price to sales is pretty high, isn't it? Talk to you later. Cheers.